if I think about this space more than anywhere else, yes, there's some proven things that don't require attention, they require capital. Solana, Ethereum, Bitcoin. But the rest of the space is attention, and it tokenizes attention in various forms, whether it's helping build a product via awareness or just a meme, whatever it is, doesn't really matter.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. In this recent interview on Raoul Pal, the Journeyman with Raoul Pal, we delve into the concept of exponential growth, exploring the rapid advancements in technology and the wide-ranging impact it has on various aspects of our lives. My friend delves into his analysis of the exponential growth in technology and its impact on different industries, specifically cryptocurrencies and artificial intelligence, during our conversation. Bitcoin is currently priced at $56,000, experiencing a slight decrease of less than 1% in the past 24 hours and a 10% decrease over the last 7 days. A friend discusses the current state of Bitcoin trading, highlighting recent fluctuations and explaining how it has outperformed traditional tech stocks such as the Nasdaq. Pal presents his crypto thesis, highlighting the transformative potential of digital currencies and blockchain technology in shaping the future of finance and economics. And lots of things Raoul Pal discusses, so please watch the video to end. And share this video and subscribe our channel Everyday Finance. Thanks.
The other thing I'm trying to think through is the market now wants less FDV, and they want, let's say we go to the ICO model where 70% of the tokens are released early. The other issue I have is, having seen things like EOS, is the moment people crystallize that much money, they don't give a shit about the protocol or the thing, because the alignments get misincentivized. And I'm not sure, and I'm still thinking this through, whether a high FDV, low float actually forces those teams to really drive value and economic models, because they don't realize all of the money up front. Because the more you realize money up front, you get capital now for future work. The issue is even Bitcoin alone performs at 150% a year since 2011. And the earlier stage, high adoption tokens, Solana, Ethereum, are much higher. So the amount of new capital and wealth it creates just means this endless capital gets recycled into the system. And until you see network growth slow down, and we're barely there yet, we're only still going up the exponential curve, it's difficult to think we can get capital efficiency. The only way, I guess, is at the tail, because there's so many tokens launching. I also, thinking through, I've been speaking to Kevin Kelly at Delphi, a good friend of mine, talking about attention being upstream of everything. And if I think about this space more than anywhere else, yes, there's some proven things that don't require attention, they require capital. Solana, Ethereum, Bitcoin. But the rest of the space is attention, and it tokenizes attention in various forms, whether it's helping build a product via awareness or just a meme, whatever it is, doesn't really matter. The issue I've got is we are growing tokens faster than we're growing net new attention. So there's a finite amount of attention that's currently in the space, and therefore we're all struggling with this. You simply can't keep your eye on everything. So you have to farm it out, right? Something like Anson will be looking at, the real kind of risk end of the table. Somebody else will be looking at a different part, because you just can't keep on top of it, which tells us we don't have enough attention for the amount of opportunity, or whether those turn into opportunities or not, which is one of the reasons why the long tail is very difficult now. Yeah, I've been very interested in following the whole Sui journey, just because these guys are really at core Web 2 people who then became total experts in Web 3, and just seeing how they're abstracting away a lot. And also, they've got a lot of technological breakthroughs, the whole new Mr. Sentai thing, Mr. SETI or whatever it is, the latency, that latency is really important in a Web 2 world, because we're used to zero latency. But in crypto, we're used to latency, and it's actually a bit clunky. So there's a lot going on there. But I do think you're right. I think the big breakthrough is going to be integration into that gigantic world of 8 billion eyeballs or 6 billion eyeballs. The Blinks one, at first I was really like, this is incredible, and it is great, but like I use a Safari browser. I can't even see these things. Even if I use Chrome and I gave it to a friend who's not in the space, if they don't have a wallet, it's nothing. So it's actually for crypto people when they're having a Web 2 experience. We haven't actually bridged that gap to make it Web 2 for Web 2 and nobody knows what it is or cares.
Yeah.
The price movement of Bitcoin has attracted the interest of experienced cryptocurrency strategists. The market has been consolidating since March, showing a prolonged sideways movement. These patterns have historically been a sign of significant price rallies, indicating that Bitcoin may be on the verge of another major ascent. The recent performance of Bitcoin shows a remarkable similarity to its past patterns. For example, between March and October of last year, Bitcoin went through a phase of stagnation before undergoing a significant 3x increase. This historical pattern gives analysts reason to be optimistic about a potential similar scenario in the coming months. Jason Pino, an analyst, highlights that Bitcoin's 6-month consolidation in the previous year set the stage for its eventual breakout. With the upcoming US presidential election, Bitcoin's potential price movements become even more intriguing, going beyond historical patterns. In 2020, the election of Joe Biden as president coincided with a remarkable surge in Bitcoin, the cryptocurrency surpassing its previous all-time high. This surge tapped into a broader trend. Market sentiment and investor enthusiasm are growing as the fourth quarter approaches. Market observers are closely monitoring the behavior of Bitcoin, with speculation surrounding the possibility of increased volatility and a potential breakout, similar to what occurred in 2020. It is uncertain whether Bitcoin will reach its all-time high before or after the election, as pointed out by Bazo. However, the overall market sentiment remains uncertain. The outlook continues to be positive. Bitcoin's current consolidation may be indicating the potential for another significant development, reminiscent of its past performance. Historical patterns and the upcoming US presidential election are both expected to play crucial roles in this. Investors and traders are approaching the market with a cautious optimism, as they always do. It is important for market participants to closely monitor developments and stay informed about potential catalysts that could impact the price trajectory of Bitcoin. Let's back to the Raoul Pal interview.
How I started framing this, I always try and simplify, and I've got it down to this. This is the underlying, it's the new underlying infrastructure for the internet, as we've talked about. And people get confused. When I go around marketing our Thunder funds, people get confused still but there's this Bitcoin narrative, this narrative, that narrative. And I'm like, stop. These are all decentralized businesses that sell block space. And they have different qualities to their block space or a different narrative on what makes their block spaces effective. And that is, once people see that these are essentially decentralized businesses that operate and sell block space, people start to understand. And what's unique about this infrastructure layer, it's the first infrastructure layer in history that we can all participate in because of the behavioral incentives of a token system versus equity. And so when I look at it, I just look at the growth of the space, and it grows at 100 and something % a year, which is twice the speed of the internet, because obviously it's built on internet rails, so it should go quickly. And I just extrapolate that trend out, and I look at it, and it's like, well, it's a $2.5 trillion space today. If we carry on, by 2032, it's 100 trillion. I'm like, that's the largest accumulation of wealth in all human history in the shortest period of time. Even if I'm wrong by 50% because I'm a total moron, it's the same as 100 years of value accrual of the S&P 500 in 8 years.
Right.
It's bananas. It's because we can own this adoption layer, and all of these businesses selling block space, that's all it's about. Best thing is just try and capture that growth first. If you're going to do anything in the space, stop trying to focus on the one thing. Just capture 2.5 trillion to 100 trillion. You'll be absolutely fine.
Right. Raoul, you're making my calls for 10 trillion this cycle look bearish.
Well, my view is like 10 to 15 trillion for this cycle. So
Got it.
roughly in line with you. 10 would be normal. 15 would be kind of a blow off end of cycle. And we don't know what the structure of the cycle is going to be. But if you just take that rate of growth and extrapolate it out by 2032, you get pretty close to 100 trillion because the compounding of these numbers goes up so wildly. I don't care what people's philosophies are. That's not how you make money. What you make money on is owning the best performing asset on a risk adjusted basis. So what I tend to find is that the mid to upper part of the curve, which is networks gaining adoption, do best. Ether last cycle, Solana this cycle, and whoever it's going to be this cycle, whether it's Sui or whether it's Near or whatever it is, I don't know. We will see that, right? That is the easiest opportunity we get in this space to generate wealth. So firstly, focus on that. That's the do not fuck this up thesis. If we're going from 2.5 trillion to 100 trillion, do that and you'll make a lot of money.
Yeah.
And so then I just filter out as many people as possible. I really only get signal from a few people that I'll ever listen to. If you tweet something, I'll always read what you tweet because I think you'll have a high signal to noise ratio. Most people are high noise to signal ratio. And so I'll observe it for sentiment and any nuggets, but I try and filter out as much as possible and just stick with, unless something shows that network adoption is slowing, I'm right. So just capture that.
Right.
Then I don't FOMO in the rest. I just don't do it. So I don't spread. I did that last cycle. I tried to spread amongst this narrative, that narrative. And what I do now is really simple. It's idiot proof. I just put the chart against Solana. If something looks like it's a sustained trend against Solana, I'll allocate some capital to it. And again, only about 10% of my portfolio will I do in that kind of stuff. But you can make a lot of money in those. And so, that's what got me into WIF and Bonk because they were outperforming Solana. So I'm like, okay, I can do that. And now, if anybody shills me something, I just say, well, show me the chart outperforming Solana and I'll take a look.
Right.
That discipline makes it ultra easy for me because I think because of this everything code liquidity cycle, everything is correlated, every asset in the world, which makes it and it's all driven by the same debt refi cycle, which makes it, I think, the easiest macro risk-taking environment of all time. Because the central banks have also taken the left tail out by saying we can't let collateral fall too far, so we will debase currency. Holy shit, if this is the case, then we have the simplest, easiest risk-taking opportunity of all time. So hyper-concentrate, I think, is the way. Now, there are people who can do the tail part, hyper-concentrate and get it right. But the probability is lower, and then you break the first rule, which is don't fuck this up. Because if you get taken out in the cycle and lose your capital, and this cycle is going from 2.5 trillion to 100 trillion, that's bad.
For weeks now, the German government has been actively selling significant amounts of Bitcoin. The recent sell-off in cryptocurrencies last month was largely influenced by a significant development. The German government, specifically the Federal Criminal Police Office known as the BKA, sold a substantial amount of Bitcoin from a wallet linked to a defunct movie piracy website. According to data from blockchain analysis firm Arkham Intelligence, the BKA sold 900 Bitcoins in June, valued at around $52 million. Last week, an additional 3,000 Bitcoins worth approximately $172 million were sold by the government. To add to these sales, the police sold another 2,739 Bitcoins, or $155 million worth of the cryptocurrency on Monday. The price of Bitcoin has experienced a significant decline. Bitcoin experienced a significant drop, falling below $55,000 on Friday, reaching its lowest point since February 2024. At one point during the day, the entire crypto market lost over $70 billion in combined market capitalization within a 24-hour period. Germany's Bitcoin sales are just one of the many concerns for crypto investors. The cryptocurrency has faced additional challenges due to the distribution of a significant amount of digital currency from the bankrupt Bitcoin exchange MGO. The trustee for the MGO bankruptcy estate, Nobuaki Kobayashi, recently announced that repayments in Bitcoin and Bitcoin Cash have commenced for some of the creditors through specific crypto exchanges. Hundreds of millions of dollars may seem like a significant amount, but in the grand scheme of Bitcoin's overall token issuance, it is just a small fraction. Currently, there are approximately 19.7 million Bitcoins in circulation, valued at a staggering $1.1 trillion. For investors, the focus lies in understanding how these sales are influencing market sentiment. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance. And we will meet in next video. Thanks.